not only for me, but for yourself. I think more than us, it is for you and the next generation that having the knowledge about these financial concepts is very important. Basically in this instruction course, at the end of the course, you'll have that much knowledge that you'll know what not to do. That's more important than knowing what to do, because we all at our different stages of our careers have made many mistakes, and I don't want any of us to make those same mistakes. So going forward, I'm Dr. Nikhil Pal from New Delhi. I'll be speaking here on various concepts in financial planning, how to diversify your portfolio, how to save tax. Dr. Raju, my colleague, will be speaking on that. Insurance, health insurance, term insurance, which to take, how to decide, mutual funds, stocks, which and how to select. All these we'll be discussing here. And it's going to be an interactive discussion, so at any point you can stop us, ask the question there and then, and just clarify your doubt, okay? So I'd like to thank my mentor, Dr. Ramnath Gute. He's a radiologist from Mumbai, and he's the founder of a group called WealthCon, and it's grown to more than 70,000 doctors all over India. And basically, we initially learn ourselves and then pass on that knowledge to other doctors. And this group is a very coherent group, very interactive, and I think all of us should go onto this website and just become a member of that. It's totally free, totally free. So why doctors should learn finances? Because we don't want to buy any ignorant policies. These LIC policies, they are sold by agents for their own commissions, and end of the day, the returns which they give are very minuscule, even less than FDs. And we are all very intelligent people. We can apply that knowledge in finance and earn more than what we earn probably right now. So basically, we have two kinds of income. One is a passive income, which we earn professionally by doing good quality work and patient care. And other is personally, this relieves the tension of building our net worth and gives time for the family and living a better quality of life. So what's the thought process? How you differentiate the thought process of the poor from the middle to rich to wealthy? A wealthy person not only has a good income, but he reduces his spending to minimum, generally doesn't take a loan, builds up on his assets, and knows these terms called valuation, capital, business, asset. While a middle class person, he is basically caught in paying EMIs. He has these products of prestige, cars, gadgets, and talks of politics all the time, gossips about on social media. So that thought process we have to change, and if we want to upscale ourselves from a rich to a wealthy, these are the things which we have to take into consideration. What is financial independence? It is when your passive income becomes more than your monthly expense, you have achieved your financial independence. And the retirement means freedom from financial worries, and that's when you work not for finance, but for your own passion. And people will say, oh, you are learning finance, you are going into trading, it's a jua, don't go into that gamble. Ultimately, whatever we are doing professionally, it's for money. And it is an important thing, not only to survive, but to improve our standard of living and for our children. So end of the day, we can't escape that. Finance is important. People say finance is, we ourselves think, oh, it's difficult, we will not get time to basically analyze. But take my word, even if you spend 10 minutes to 15 minutes per day, that's more than enough. And the result you will know in 6 months. It's not an immediate result, you have to be patient. And if you spend just 15 minutes, 20 minutes a day, it's enough. And I'm happy to say that of the people who are joining in this group, now it's the females are more than the males. Almost 70%, the new joinees, 70% are females. And take my word, the kind of multitasking all ladies do, we males don't do, and they are much better financial advisors. So to my thinking, you should not outsource your finance to anybody and should do it yourself. Money, we know that money is important. Basically, whatever services we provide, we earn money, and we spend that in various goods and building up the assets. And this money is important. Initially, we used to pay in currency. Gradually, we are moving towards digital. And India, we know it's a big growth story. The GDP of India is increasing every year. So I'll suggest instead of investing in US market or any international market, we should believe in India. We should believe in the India growth story. And whatever we invest should be in India. When we discuss finance, when we discuss money, the term is wealth. And the wealth doesn't only include financial wealth, but includes social wealth also. Basically, how good a family, friend circle you have, how much time you spend with them, with the family and with the friends. It includes time wealth. Time wealth is important because you should be able to stratify your time. You should not be wasting time on social media, wasting time on gossiping. Rather, you should use time judiciously. And even if we have to outsource your work, hire more people. If you have a big hospital, keep managers in your hospital. Outsource your work, pay them well, because end of the day, that will give time for yourself, for your own self, and that is the most important thing. And at the end of the day, health is wealth. So unless you have a good health, whatever money you will earn at 50 years, 60 years, if you get comorbidities, you will not be able to spend a good life. So you should take out time for yourself to have a healthy life. That includes a balanced diet, doing exercises every day, spending time for your own fitness. So today's talk, basically, I will divide into basically what to do about your earnings, your spendings, how to save, where to invest. And a second part would be on taxation, how to save your tax, which loans to take, not to take, how to take insurance. So basically, when we talk of earning, there are two types of earning. One is an active income, which comes from your salary and the professional fee, and the other is passive income. So our focus of the talk is on passive income. This passive income may be either by trading, maybe by short-term or long-term capital gain in equity or mutual funds, by rent income, by interest income, and dividend income. So there are two type of spending. One is on the products of need, which you actually need. And the other is product of prestige, which you basically buy and take photos and put on social media. So our thought process should be to reduce these products of prestige to a minimum and increase the spending on the products of need, basically. And whenever we invest, you should be aware about these terms. One is, when you invest into something, you should have already the exit plan in mind. Like if you are investing into something, you should have those financial goals ready. Like at 5 years from now, your elder child will go into college, you'll need money. 10 years from now, your child will get married, you'll need money. 15 years from now, maybe they go abroad, they'll need money. You want to set up a hospital, you want to buy a house. So already your exit plans should be ready and your targets should be goal-based. You should be aware about how to calculate. I'll come to that. You should be aware about cost of whatever you're investing in, the taxation involved, the risk involved, the return involved. We'll be discussing about these terms called GRED. Here, G stands for gold, R stands for real estate, E stands for equity, D stands for depth. So how to diversify your total investment into these four brackets. And you should, at the same time, be aware of terms called inflation, compounding, the future value of money, and doubling the money. So when we talk of inflation, it is invisible taxation without legislation. In India, approximately the inflation rate is 6%. And this is basically price-based and lifestyle-based. So if you are investing into just plain fixed deposit, a good fixed deposit maximum gives around 7% return. If you're in a 30% tax slab, which most of us doctors are, and when you take out that fixed deposit at maturity, what you get is 4.9%. So if you take in the invisible inflation into account, if you're just putting your money into plain fixed deposit, you are losing money. Okay, so it's a big no. Fixed deposits, we should just keep our as emergency corpus into that, but it should not be an investment tool. And we should be aware of a term called compounding, which means your money keeps increasing every year. And this compounding happens, like if you see Karina, if she starts investing at age 20, her investment amount is just 6,000, less amount, but she's invested for 15 years. At that what total corpus which she has invested 90,000. But at retirement, that amounts, because of this compounding, will become 28 lakhs. If you take 9% basically interest per year. While Karishma, she starts investing at a later age, 35. She invests more than double the money of what Karina is doing. And she stays invested for 30 years. At the end of that, her retirement amount will be less than what Karina had. So basically this slide shows earlier the better. Don't think that I'll do it in 6 months from now, 1 year from now. Today is the day. Today you start investing for yourself. Okay? And amount is not important. Even if small amount, 1,000 rupees also you invest, it's good enough. Okay? And whenever you calculate how much return you get, just be aware of this formula, like we used to study in mathematics in school, that the future value is the present value or the principal into the return and superseded by the number of years. So you see that from 2010 to 2020, the value of all the products have increased. And this rule should be aware that 72 divided by the interest rate is the number of years you take to double your money. So if you invest in a tool which has a higher interest rate, you will double your money earlier. When we talk of investment, we basically invest to build up our assets. There are two types of assets. One is a true asset, other is a pseudo asset. True assets basically are cash, fixed deposits, mutual funds, land, commercial buildings, gold, which are easy to sell. While pseudo assets are difficult to sell, we have an emotional involvement with them. They are mostly products of prestige, like house, car, furniture, gadgets, jewelry. So we should spend our money mostly in building up the true assets and not pseudo assets. And when we speak of these assets, they are basically four: gold, real estate, equity, and debt, GRED. So these four we should build up. I'll come to that slide later. And we should diversify it into a formula, which basically the younger you are, suppose you are 30 to 40 year bracket, if we take most of us doctors for either hospitals or for house, we have to invest in real estate. So that real estate amount, if you suppose you take as 40%, so rest of that 60%, if you are young, should be mostly into equity. But at the same time, 5% into debt as an emergency corpus, and 5% into gold. As your age increases, till 50 years of age, basically that equity, you can still keep a huge amount, larger amount compared to the other. But as you start to reach to the retirement, you should start shifting your money from equity to debt. Okay? And don't try to invest into risky things. But at the end of the day, when we invest into these products, you see this graph. You see on the left side that gold and equity, here it's going up. It's like a snake, which is going up, then coming down, going up, coming down. So last week, you must have seen in the news and the newspapers, Nifty is crashing, US markets are crashing. But you see, it's not a news story. COVID time also, it crashed. But you see today, it's again gone up. So when it's crashing, that's the best time to invest to your money rather than coming out, okay? And debt you need because you need some emergency corpus, which money shouldn't go away, should not vanish. So at the same time, depending on that GRD, I come to that slide again, do have that money in mind for the debt and just diversify. I'll come to how to watch all each sub-thing has. And so basically, when we talk of gold, there are two types of gold investments you can do. One is either pure gold, gold bars, jewelry, coins. The other is digital gold, which may be either into mutual funds, which invest into gold. They are called gold ETFs, exchange-traded funds. And third is sovereign gold bonds, SGBs. You may have heard about SGBs. So basically, we should shift from like our parents and grandparents used to keep all money in gold, solid gold. Problem with solid gold is that they are making charges, conversion charges, and when you go to sell them when you need money, they will also cut the money. So you should avoid having solid gold. These days, like personally, my children, they don't take pure gold in marriage or anything, so ultimately it's going to go waste. So I think shift that money gradually into digital gold. And this digital gold, has a lower cost, they have tax benefits, especially sovereign gold bonds, and they should be used as a long-term investment tool rather than pure gold. So when we talk of sovereign gold bonds, I'll just quickly tell here that these sovereign gold bonds are issued by the government, and basically there's no taxation involved if you hold it till maturity. You get it when the primary tranches are released, you get it at a discount. And now the government has realized that they have spending so much amount on the sovereign gold bonds, so they have stopped issuing fresh tranches. But still, the sovereign gold bonds are available from the secondary market. You can still buy from, if you connect with me, I'll tell you how to do that because it's a long talk. But the sovereign gold bonds, you can still buy from the market at a slight premium. But when you sell them, you'll get all those benefits, taxation benefits and all you'll get. Okay? So I'll leave the taxation out because my colleague, Dr. Raju, will speak on that. And I've already told you the benefit. So gold, either ETF, they are called gold Bs. You can note down the name. You can invest into gold Bs, or you can invest into sovereign gold bonds, but never invest into physical gold. Coming to the debt products. So these debt products, they are either your provident funds, your Sukanya Smridhi schemes, senior citizen schemes, fixed deposits, government securities. There are exchange-traded funds called liquid Bs, liquid funds, gilt funds, arbitrage funds. So the liquid Bs and liquid Ks, they are basically traded on the National Stock Exchange, and they are also by various brokers they are issued. These debt products you should use to park your surplus funds in the demat account, and basically even the emergency corpus you should keep in that. How much to keep in this? I already showed in the GRED how to decide how much to invest into that. And liquid funds, they are debt mutual funds. These invest in highly liquid money market instruments and debt securities. Treasury bills, they are issued by the government. They have maturity not more than 91 days. So if you want to keep your money with minimal risk for less duration, you think in 6 months you'll need the money, these will give you more return than your FDs. So better to keep in these products, okay? And the government securities are also bonds issued by the government. If you think you want to keep your money for 10, 15 years, they give a good return, 7.26% return. So you will never lose your money. And you can always withdraw your money before. So these are different tools. My aim here is to make you aware. See, it's very difficult from immediately to start investing. But if you're aware of these terms, you can discuss them with your chartered accountant, with probably some financial advisor, and start on your own. Unless you are aware, you will never do that. So he'll tell about taxation I'm leaving out. These are not tax-free. Only sovereign gold bonds at maturity are tax-free, but he'll cover everything about taxation. Okay. Another funds you should be aware is these are called arbitrage fund. Unfortunately, very few of us are aware about this. This behave like debt. They are very less volatile. They give returns equal to your other debt products, 7 to 8% return. And basically, they take a differential between the buying and the selling price. I'm not going into too much detail. At the end of the day, arbitrage funds, the advantage is that you don't lose your money. You get returns almost or more than your debt product. And the basic advantage is that when you withdraw this from the arbitrage fund, they are taxed at equity. So if you are putting into debt product like a fixed deposit or a debt mutual fund, you are taxed at your slab rate. Most of us are slabbed at 30%. So whatever profit you have earned in your debt product, 30% is cut from the profit. But this arbitrage fund, they are taxed at equity. Okay, so they are taxed at 12.5%. Okay, approximately. He'll come to that. So you save that much also in taxation. So if you are aware about taxation, you will be able to invest in a tool where you will keep your money safe, but at the same time, you will pay less amount to the government. Government is already taking so much of taxes from us. So if we minimize that, that's a benefit. So I'll suggest if you're investing into debt, so you can, even in debt product, don't keep one egg in, all the eggs in one basket. In that also, just invest that debt portfolio into 2-3 things, okay? Regarding equity, so the the things which are included in equity are exchange-traded funds. I'll come to that. They include your Nifty Bs, Junior Bs. I'll come to what they mean. Stocks, what we all know. My colleague Dr. Raju will speak about how to select them. And you can invest into direct mutual funds directly also. They are categorized into basically large cap, mid cap, small cap, flexi cap. I'll come to that. And I'll skip this. Dr. Raju will take a separate presentation on that, so I'm just skipping this. Mutual funds, they are basically packed and branded products. They may be not only into equity, they may be into debt products. And basically, you can do a SIP in them, and whenever the market is going down, you can increase that on the dip. And but at the same time, you should be aware that they are not perfectly safe. They may be having a risk involved, so keep that in mind. And there are two types of mutual funds. One is called direct, and the other is regular. So what happens is whenever we have a financial advisor or an agent with us, they will invest through a regular mutual fund. And when you see the detail, it will be mentioned this term regular. Don't ever take that regular because they have a hidden commission in them already there. So the profit, that hidden commission will be reduced in whatever profit you have. Rather, you should start investing directly, and these mutual fund they will be same, exactly everything will be same, only they will have a term direct return in front of them. So when you invest in them, that 1%, almost 1% profit you can increase by that. And it's very easy, it seems difficult. You have to log in. There are various ways you can buy that direct mutual funds. You can go directly to the AMC on the, like suppose you want to buy a Parag Parikh or a Nippon or a Invesco or a Canara Robeco. You can go directly on their website, it takes 1 minute to create your profile. You can put in the search which mutual fund you want to select and buy directly from there. It just takes 5 minutes. So don't route it, don't outsource it, do it yourself. Okay, and here you can see that if you have invested into direct versus regular, at the bottom, every fund on the left and the right, you can see the difference in the return. It's almost 1% difference. And on the right, you can see what difference that coming is. It is coming of 20 years. For 20 years, if you are investing 10,000 rupees per month, 17 lakhs, you see on the right side, 18 lakhs, 24 lakhs. That's the amount you are saving if you do it directly. Okay, so do it directly, never regular. And basically the mutual funds, there's a mnemonic, it is called CARESA. I have a separate talk on that. If time permits, I'll tell how to do that. These are big topics, huge topics, I know, I can understand, very difficult to grasp. Don't expect that listening to this talk immediately you will start investing and learn. I'll suggest join the group, it's free. There are passive groups there, 10,000 messages are there, just go through them. And it's easy. If I have done it, in COVID time, I had zero knowledge. I didn't have a Demat account. I did not know ABCD of anything. And if I am standing here giving a talk, I'm sure it's doable for you, especially ladies. More than 70% of the new joinees are ladies. So they're very good at it, and you should do it. Okay, don't leave it to your husband. Don't leave it to anybody else. Do it yourself. So basically, whenever you're doing a mutual fund, it should be direct, it should be growth. Again, they may have either growth or a dividend, those kind of terms return. So always select the direct and the growth. Again, in mutual funds, don't invest in one. There are small cap mutual funds, middle cap, mid cap, large cap, flexi cap. So select one of each. Okay, and I'll take a separate talk on how to select that probably. Okay, and whenever what happens is you go to agent, he will keep 20, 30 mutual funds for you. And he will keep buying, selling. He will keep churning your portfolio. But that's where he earns his commission. So if you have invested in a mutual fund, don't keep seeing it every day. Don't keep seeing it every month. Maybe review once in 6 months, once in a year. And see it for 2 years, 3 years. Because if you select a good mutual fund, you will know the benefit in 2-3 years. And if it's not performing, then change. Otherwise, don't change. Okay, and these AMCs come out with very new terms of mutual funds. Never select new mutual funds. Always select more than 3 years old, 5-year-old mutual funds. So I'm just skipping this. I'll take a separate talk on mutual funds. Okay, I'm just basically making you aware that these kind of things are there. And in mutual funds also, you basically invest SIP. It is called systematic investment planning, wherein every month you invest something some amount in the mutual fund. It automatically deducts from your bank account. Even if the market is going up, going down, it automatically deducts. It's on a fixed day. And generally what we suggest is putting that date between 20 to 25th of the month, because there have been many research studies where they have found that keeping that in that period generally gives you more return comparatively to other dates. Okay, and besides this, so you see here the Nifty chart is going up, down, up, down. So keep on your SIP on. Don't stop your SIP. Okay, whether it is in gold, whether it is in Nifty, whether it is in mutual fund, keep your SIPs on. Okay, and I'll just come to that. So basically, you see here, see, you started your investment on suppose 7th June. Okay, you keep buying it, but it goes down. Don't stop your SIP. But when the market starts to go down more, it's called dip buying. Dip buying means basically when the market goes more than 5 to 10% down, do a lump sum investment also at that same time. Okay, and SIP you can do basically in equity, gold, debt products, all the things. And these are the basically equity products where you can do the SIP. Even in individual stocks, you can create a portfolio and keep your SIPs on at a passive. Don't track the market. Ultimately, our profession is our main. We don't want to basically leave that, and it should be all passive. We should try that it should be passively automatically deduct, and we spend more time on the patients. And these exchange traded funds are basically, they are type of security. They track either the index, the sector, commodity, or the asset. The beauty of them is that they can be purchased or sold on a stock exchange the same way as a regular stock. If suppose in mutual fund you are investing, whatever, suppose at 10 o'clock you put your money, it doesn't come into your account immediately. It's at the end of the day, whatever the value is calculated, the money is the units are deducted according to that. But when you buy an exchange traded fund from a broker or demat, the value which is mentioned is exactly that which comes into your account. Okay, so the commonly traded these exchange traded funds, they are Nifty B. Nifty Bs are basically, they track the first 50 stocks of Nifty, the top 50 stocks of Nifty. So they behave exactly like top 50 stocks of Nifty. The advantage of exchange traded fund is that we call a term called expense ratio. This expense ratio means what is the money being deducted by the AMC for buying that. So that is very minimum, 0.05. So it is very less. While if you buy a normal stock, a normal mutual fund, it will be 1%, 1.5%. Then there's another exchange traded fund called Junior B. This Junior B will track the stocks from 50 to 100, the top 50 to 100. Okay, so they will give you more return. They will have more risk involved, but at the same time, they will give you more return. And other exchange traded fund is Gold B. So if you are diversifying your portfolio, buy the Gold Bs because they will have a less expense ratio. They are digital. You can buy immediately. If you need money, you can sell immediately. Okay. If suppose you want to invest in a foreign market, you say, I want to keep some money, I want to diversify and put in the US market. Today, US market is so down. So I'll suggest it's a good time to put some money in the US market also. So they are exchange traded. Don't open an account for US market. The taxations are too high. Almost 10-15% of your profit, the broker will eat away just for opening the account and transferring the money. Rather, you can buy these. Motilal Oswal has come out with the MON 100. So they invest in these US market equities. There's another ETF called MAFANG, M-A-F-A-N-G. They will basically invest in the top 5 stocks of the big 5 of US market. So buy directly from your broker. And again, the expense ratio will be very less. And like I already told, debt product also you can keep buying these liquid Bs, the exchange traded funds. You can buy them, sell them immediately with a minimal expense ratio. Okay, so I've already talked about the advantage of the exchange traded fund versus individual stocks and mutual fund. Okay, I hope there's no confusion about this. I know it's difficult, but if you're aware, you can go home, discuss, and know about more. So dip buying, like I was saying, that whenever the market falls 5%, 10%, as the market keeps going down, keep investing. Don't come out, okay? And basically, there's a thing called pyramid buying that whenever the market goes down more, your investment amount should increase accordingly. Because ultimately, we saw that snake, the market went down, but it came up. So your return potential will increase much more if your investment corpus has increased when the market went down. The only thing is that we don't know how much market will go down, till when the market will go down, till when in reverse. Here is where the mind management comes into play. You should be, like suppose you have 100 rupees to invest. Don't invest that 100 rupees at the first go. Like so today you see the 10% market is down. Don't invest that 100 rupee immediately. Do it slowly. Keep patience. If market recovers before that, don't regret. Don't regret that the market is regretted. I could have done that. I would have done that and this, that. These thoughts should not come. Ultimately, 5 to 7 years is our goal. Don't think short term. Don't think short term. Think long term. And long term means 5 years, 7 years. And believe me, you will get that return, which will beat on more than 95% of even the huge brokers who are earning, okay? So know yourself. I may be having a big hospital for my parents. Maybe I don't need the real estate money. So increase your equity portfolio, increase your gold portfolio. Or I may be very young, I may be not having anything. So each individual's basically targets are different. The time targets, what age. If I'm 20, I have more time to compound. If I'm 45, I have less time to compound. So set your own goals. Don't look at another person, look at yourself, look at how knowledgeable you are today and how knowledgeable you are 6 months from now, okay? And there's a mnemonic called KISS, which means keep it simple, silly. That means don't overcomplicate. Don't take tips from anybody. People may don't join these social media groups. Don't listen to news. Don't join the economic channels news, because what they speak is pure entertainment, and that doesn't work. Okay? Keep it very simple. If you don't want to think too much, just diversify, GRED, like I told. Just keep the SIPs on in these, depending on the exchange traded fund. Even if you don't invest into stocks, even if you don't invest into pure mutual funds, if you just keep your SIPs on in exchange traded funds and buy more at the dips, believe me, you will beat 90% of the people in the returns what you get. I'm talking of 5 years from now, not immediately, okay? And another mnemonic, very important, PDF, patience. You should have patience. Discipline. Discipline means you should not get distracted. You should know what is your strategy. Keep doing that strategy. And have faith. Have faith in yourself. Have faith in India. And have faith in the bullishness of India, okay? Taxation, I'll skip. Dr. Raju will take that. Insurance, probably I'll take a separate talk on that. I have a very nice talk. So I'm just skipping here. Loans, I'll say here that basically taking loans and ignorance policies are wrong and expensive ways to save tax. And basically, there are two types of loans. One is a bad loan. Bad loans involves taking a credit card, buying everything on the credit card, taking loans for buying goods like cars, gadgets, or taking personal loan for any personal expense. So avoid taking these bad loans. Still, loans if you require, and they may be good, maybe either for your own house, where you want to stay, for your own hospital, where you want to work, or for your own education or children education. They keep it minimum, but if you want to take only these, okay? And keep your loan amount to minimum. Try to have it for the shortest duration. And remember, like if suppose you take a 10-year-old loan, try to prepay as early as possible. It's the initial 6 months, 1 year period when bank earns maximum interest on the principal. So try to prepay as much as you can in the beginning itself, okay? And basically credit cards should avoid as much as possible. You should basically pay whatever is required money immediately. Don't let it overdue, because your credit score can go down. If your credit score goes down, taking loans may become difficult later on. And each one of us has different life stages. Less than 30, we are more into learning, and we don't have any earning. Middle life, where we are creating our wealth and earning actively. And at 60 years, where basically we want our wealth to be protected, and we want more of a passive earning. Okay? So at the end of the day, basically in the mind, you should think that 50% of what you earn goes into your taxations, into your insurance, into your EMIs, and into your school fees. 25% of what you earn goes into your expenses monthly, and rest at least 25% you should save for these investments into GRED. So calculate according to your own earning, calculate 25% comes to what, and this 25% invest, save and invest into GRED. Okay? So be self-reliant, start learning today, take action today, open a demat account today itself. There are discount brokers, very minimal charges, very easy to open. Just open a demat today. Don't use it. I'm not saying use it. Just open it. See how if you go on the website, you will open, you will learn. Just keep it open, okay? And like I told, mutual fund, only direct plans, no ignorance policies, no LIC policies. Tax planning, very important. We have a separate talk on that. And clear your debts, clear your loans as early as possible. Thank you.
Thank you, Dr. Nikhil, for that wonderful talk. We'll go on to the next talk, and let's see.
You want to, maybe insurance I can speak? Then, okay. Yeah.
Presentation, please. Thank you, Dr. Nikhil, for having me here. Dr. Nikhil was my senior at AIMS, and now he's a senior guide at WealthCon, and he's one person from whom I have learned during my JR-ship, and I continue to learn even at 50 now through WealthCon. Thank you, Dr. Nikhil, for having me here. Only thing is that this IC was actually not planned. They gave us this IC 1 week back. So we were all running around to whom to start, how to go about the presentations. So it's all put up together in a very small time, and I had my presentation about tax previously done in our state conference. He said that you have that, you do it. Only, I thought it's okay, I can finish off this presentation, only to realize that Nirmala Sitharaman madam has changed so much in this budget that I had to do the whole thing sitting in the night yesterday. I had to do this presentation again to tweak the rates that were there, what all they changed. So I had to redo the whole presentation. So I'll tell you, first disclaimer is I'm not legally a financial consultant. So please consult your qualified financial advisor or a chartered accountant. Tax laws change and individual circumstances can impact your tax liability. So professional guidance is crucial. What we want to give you here is to understand the various terminologies that are there, so that when you talk to your tax consultant, we should not be ignorant. We should ask the right questions to get the correct savings that we are entitled to. Otherwise, they do a very superficial work and will end up paying more taxes. They may show you some minimum tax saving, but you can actually save tax more. Now, how does tax impact us? So let us assume that you have to buy a laptop that costs 1 lakh and you pay a GST of 18%. So total cost is 1,18,000. So this is what we all thought. Okay, this is how we are thinking now. So I paid 1,18,000. If I have 1,18,000 in my bank account, I can buy this laptop. You are correct. But suppose you think that you had a gross salary of 30 lakhs. Now, first you have to pay income tax. Then after you paid the income tax, then you're left with the income in your bank. That is the real income that is left after tax. So if you spend 1.18 lakhs, then what is the effective cost, including how much you already paid for tax on that 1.18 to be there in your bank account? Okay? So to understand how it is, so the salary before tax is, this is the calculation, is 30 lakhs. So you paid 4.8 as income tax. So your take home is 25.2. Okay? So that is the net in your hands. So the effective tax rate for your 30 lakhs is 16%, total put together. So remove all the tax slabs. So your effective tax is 16% you are paying to the government. If you earn 30, you are paying 16%. Okay? Now article cost is 1 lakh, 18% is the GST. So 18,000 is the GST amount that you paid. For that 1,18,000 to be present in your bank, you should first have earned 1,36,000. So the government takes away 36,880 rupees for a laptop worth 1 lakh. So this is the calculation that we have to think. That's how money is so important. That's what I wanted to get you involved in. So the government makes a cut of 36 or 37% if you are in a 30% tax bracket. Suppose you are more than that, you go to 50, this amount that is required is actually 1.45 per lakhs that would be required. So this is the calculation that we should think in mind. And when it comes to paying interest, that's why he said don't take loans. When it comes to paying interest, you think you're paying 8% interest. It's not actually 8% interest. 8% interest, for that 8 rupees to be in your bank, first you have to earn 8% plus 30% tax that you have to pay. So that is the total amount. So keep those things in your mind, back of your mind whenever you're doing, not the simple maths calculation. The real math is totally different. So the government makes a big buck on whatever we spend. Okay? But however, if you are having a company, private limited, then this can be directly taken away as expenses, and you can also claim depreciation. Here it is totally different. If your company has made 1.8 lakhs and you are spending 1.18 lakhs on this laptop, there is no income tax involved there, unless you are earning a lot for the corporate taxes. But otherwise, this is taken directly as expense only. So there are various incomes that are taxable, all sources, legal sources of income. How are they taxed and how to save tax is what I'm trying to tell you in this. So you have two types of doctors amongst us. One is the salaried people, whether you're in private or government, or professional fees, those who take professional fees, working in self-employed clinic or private setups or freelancing. These are the two people. Now income from sources include from salary, income from house rent, income from capital gains, income from professional or business profession, or income from other sources. Suppose you are on a panel on a medical college and you also do freelancing, so you'll have a salary income and you'll also have professional income. So both things have to be taken into consideration. So whatever you do, tax from regular, that is the salary, professional, rental, or interest on deposits, and interest from investments, that is whatever you are doing as investments, or if you are going into very advanced income from futures or options. So you will have to go through this. Again, there are two things that you need to be understanding is the old tax regime and the new tax regime. Each one has its own advantages and disadvantages. So again, you need to talk to the tax consultant, ask them to calculate it and show the difference between the two and then take a call. Otherwise, they may be just simply doing it under the new tax regime, but you ask them to show the calculation difference. Why it is important? That's because in the old tax regime, whatever we had, that these ATC, ATD, all those exemptions and deductions are available. Under the new tax regime, none of them are available. Okay, whatever you are doing, suppose you are doing, if you go into that, it will not available. However, the tax rates are different. So that's why you need to have a tax calculator. Again, you can go to the income tax website. They have the tax calculator there. Put up the things and compare yourself before you do the pay the tax. So this is the bird's eye view of all options available for tax deductions. I think Dr. Nikhil briefly told it. One thing is for the girl side, Sukanya Samriddhi account is one thing that is a very good investment. It is like a PPF in the name of the kid. And starting a business and efficient investment portfolio and filing returns timely is also very important. If you don't file your returns, then you lose many things. So that is also very important. File your returns, don't miss filing your returns. As far as your income from investment is concerned, so if you have a gain, again there are two types of gain. One is called as a short-term gain, other is called as a long-term gain. So what is short-term, what is long-term? Again, they have classified it for different asset classes. Previously, short-term gain was 15%. So now it is revised to 20%. Previously, long-term gain was 12.5% and above 1.25 lakhs. Suppose you have made an investment, like what Nikhil sir said, and you make a profit. First 1.25% of your, 1.25 lakhs of your profit is tax-free, provided you have held it for more than 1 year. Suppose you invested this year and next year, after 1 year you have sold. If you have made 1.25 lakhs, it is tax-free, first 1.25 in a long-term investment. However, you sell it 1 month before, that is at 11 months, then you will end up paying 20% of the what you have earned. So knowing these things are important. Although you made a profit, but you will end up paying more tax. Again, there is for the professionals, there is something called as a presumptive taxation. This comes under sections 44AD and ADA of the Income Tax Act. So this is people who are eligible for this is the professionals, and medical doctors can do it under this presumptive taxation. Here, the important thing is you don't have to maintain the book of accounts. Okay, so what you do is it is applicable to up to your 50 lakhs of earnings. And suppose majority of your earnings, we were discussing previously, is in digital way or through your bank account, it can go up till 75 lakhs. So if it is cash component of your business is less than 5%, then up to 75 lakhs you are eligible to use the presumptive tax. So what it means is, in the ITR, tax member may record 50% of that as taxable income. Suppose you earn 50 lakhs, 25 lakhs you should say is taxable, 50%. Otherwise, you have to pay or maintain book of accounts if you are not going under this thing. Okay. So I think for the accounting, it's 75 lakhs now. If you cross 75 lakhs, you need to keep an audit. Your account will be audited. Again, for small taxpayers, you can also have individual HUF and partnership. Here, up till 2 crores can be done under the presumptive taxation. So having an optical or pharma that is separate from your PAN would be beneficial. So you can file a separate PAN. You can have a PAN in the name of your family member or a HUF, Hindu Undivided Family, or a partnership. So you can have a different PAN so that you can take benefit of these taxes. Otherwise, if you club all the income to yourself, then you will not be eligible. So as I told you, you don't have to maintain the book of accounts, and you don't need to pay advance tax each year and can pay it in the last installment. Then what is meant by capital asset? Capital assets is owned by individual that may or may not be connected to the business, are called as capital assets. For example, real estate, bonds, equity, mutual funds, jewelry, patents, trademarks, all come under what is called as a capital asset. And profits or gains arising from transfer of this capital asset is called as capital gains. So whenever you sell this, whatever gain you make is called as capital gains. So any investment will go through these definitions, that is short-term gain or loss, long-term gain or loss. And FNO I will not touch, it's a higher thing. But again, if you are doing it intraday, that is called as speculative. There, the intraday profits are treated as speculative business income, while FNO we are doing is considered as a business income. So, whenever you are calculating the tax, it will be based on what is, how much you have made a profit minus what you spent when you acquired this asset, what you spent for cost of improvement, and the expenditure incurred wholly, exclusively in connection with this transfer. All of them can be subtracted from the gain you made. So this is legally available. So you just don't think that you had a 1 crore plot and you sold it for 1.5 crores, you made a profit of 50 lakhs. But these are all the things that you can reduce, you can use. Then there's something for long-term capitals, there's something called as indexation, indexed cost of capital. So what you bought in 2000 and you're selling in 2025, there is something called as indexed cost. I'll show you that. So this is the short-term and long-term, okay, of the equity mutual funds. Less than 1 year is short-term, anything more than 1 year will be long-term. As told, the SGB, that is sovereign gold bond, is exempted at maturity, only if it is at maturity, not before that. Then something called as a grandfathering. How many have been doing mutual funds before 2018 here? Anybody who's been doing that? So if you have done a mutual fund before 2018, February 1st, and you want to sell it today and you had a profit, then there is a different way of calculating the profit. Suppose you had a 1 lakh and now today it is 1,50,000. So it is not 50,000 as profit. There's a different way to calculate it. So only those which are bought before 2018 can be applied for this, what is called as a grandfathering. To give an example, suppose you bought a share at 100 rupees and the share in 2000 January went to 125 rupees. This is taken as the FMV or the fair market value. And today in March 1st, the share is worth 150 rupees. Okay? So the long-term capital is not taken as 150. It is not taken as 50 rupees. It is taken as between January 31st, 2018 and the current rate, that is the March 1st rate. So this you should know. Otherwise, your CA will not, if he is not aware of these things or you don't ask him, he will just make you pay for the 50 rupees that you have made, when you actually have to pay for only 25 rupees. Because the fair market value as on 31st, because this income tax rules keep changing. So this rule was changed in 2018, how much you pay. So the government allowed that if you have bought something before this, then you are allowed. Same way with respect to indexation now. Previously for land, indexation was allowed. Now I'll show you the date. After that, whatever you purchase in 2024 onwards, it is not available for indexation. Now the same share I was discussing, it went to 125. Suppose in April now, because of the market crash, if it came down to 125 or 115, okay? Now you actually made a profit of 15 rupees. But you see that its fair market value was 125 rupees on 31st. So your tax is 0. So you don't have to pay a tax, although you have made a profit of 15 rupees. That is important, because it is below its fair market value as on 31st of January. So these things, Which one? No, loss you cannot. For loss, the government will not share. Only the profits will be shared. Wherever you make a loss, it is your loss. But when you make a profit, you have to give a share of that. As far as debt mutual funds are concerned, again they changed it. Previously, they allowed for indexation. Now they removed the indexation as per before. In 2023, they removed this indexation benefit. Now, indexation is no longer available for debt mutual funds. As far as equity types exchange traded funds are concerned, short term is 20% and long term is 12.5%. And gold ETFs are taxed as per your income tax if it is short term, less than 1 year, and it is more than 1 year, it is at a flat rate of 12.5% without indexation. This is how the changes have been made recently. As far as indexation is concerned, you go to the income tax website, government website, you have this calculator there, so you can put this and then see it. But what has happened is, with effective date from July 23, 2024, only what you have purchased before this, you can offset as a indexation cost. After this, anything that you have purchased after this, you are no longer having this benefit of indexation. That means you are likely to end up more tax for whatever real estate assets that you are going to create if you sell in future. So this is the new calculator that is there. It will ask whether the transfer was done on or after 23rd. So all those things will come into picture. If it is yes, then the calculated rate is different. So the cost of acquisition is 1 crore, then the indexed cost is 1 crore 74,000 is the indexed cost according to the calculation that will be calculated by the income tax now. So these things you need to keep in mind whenever you are buying or selling your old assets also. So then there's something called as offsetting the loss in your whatever loss you have. So if you have made a net gain, then you also have a net loss, then you can subtract it against the short-term gain. Again, when you have a long-term gain, you can again offset it against a long-term loss. Suppose last year you had a loss, this year you had a profit. So the previous year's loss can be offset, and this can be carried forward for 5 years, provided you file your tax on time. If you don't pay your tax on time, then you cannot do this offsetting. So you need to be very clear that the tax filing has to be done on time. So you can ask your CA for all these things. So it will become too much for you people to understand so many things being told in this presentation. So to conclude, whatever we do, we will have to pay tax to the government. Choose whether it's an old or a new tax regime, do a comparison, and then make the choice of paying or using the regime, which regime to use. Talk to your tax consultant, ask him to show a Excel sheet of the calculations and cross-check it with in the income tax, there are a lot of good calculators that are there. So you go to the income tax website and use those calculators. It is very useful. So to conclude, a penny saved is a penny earned. That is what is more important, because whatever you save is already after you have paid the tax. So don't lose that, because if you lose that, then that is you're losing, including what you paid as a tax. Thank you. Thank you so much. Now, gold bond, the sovereign gold bond at maturity is not taxable. However, if you do it before, depending on how long you held, short term or long term, it will go through the same cycle. Short term will at 20% and long term at 12.5% without indexation benefit. Yeah.
if you are using it for the company purpose, then can we make it for the expenses, or can we claim the depreciation?
I think
Or both the thing we
both
can.
the things can be done. GST, you can input GST may not be available because you are not selling it again. But GST paid, you can ask your CA as to how you can use that. But you can show it as an asset, and it can be under depreciation. You can use claim depreciation for that. So that's the difference.
Once you have shown the expenditure, how can you show it as an asset?
No, that's what you have to talk to the CA for that.
Okay.
Okay. You can do the insurance part. That is because an important topic. Insurance, I think, let him cover.
So Raju's presented here very nicely. One slide he presented was on a term called HUF. That's a Hindu undivided family. So I think just talk to your CA about it, read about it, because that's a very important thing which all of us should have. And all of us should do that. Now coming to another important topic on insurance. What is it, which ones to take, and how to take? We'll just briefly discuss about it. It's important because ultimately anything can happen anytime, and we should be ready for it, for our family. So basically they are either term or life insurance, general insurance, which may be either for health, for accident, for professional indemnity, fire, property, car, and ignorance policies, which are basically investment-based insurance policies. So term insurance you should always take basically to give your family financial protection in untimely demise of your as an earning member. And basically any earning person who has dependents and liabilities should take a term insurance. But if suppose if you have no dependents and you have no liabilities, then no need to take that. And when you should take that, it should be as early as possible, because the premium is fixed, it gets logged, and you have to pay the same premium every year, so earlier the better. Regarding term insurance, basically you can either buy it from an agent if the family is not tech savvy. You should choose an agent who is young. Basically, you should not take it from an elderly person. He can go before you go. So always take it from a young person. And here I differ in the sense that for buying mutual funds, you do it directly. But for buying the insurance policy, term insurance policy, better to buy it from an agent. Let him have some money, no problem. But when you are a problem in the family, yourself, accident, you're in the hospital, everybody's so stressed out that you won't get time to do any paperwork. So it's best to just give him a call. Your family member should know the agent's phone number, contact details, so that that agent can handle everything and you don't have to bother about it. Okay, but at the same time, you can buy it directly from the website also, okay, where discounts are there, but still I suggest better to do it offline, pay some more money, but have it. And which insurance to buy term should be from any good and big company. See on the Google which has the highest among the top 5 highest claim settlement ratio, and buy it from that. So HDFC has a very good term insurance, Tata has very good, LIC has very good. Don't buy the LIC ignorance policy in the sense which are linked to their investment. Buy a pure term policy from LIC has pure term policies also, which the agent will never tell about that. So just ask him for that, buy it from him or buy it directly, okay? How much this term insurance you should take? Basically, it should be ideally 20 times of your annual income, or it should be minimum 20 times of your annual expense plus liabilities like loan. The sum insured cannot be increased later unless you opt for a life state protection option, okay? And basically, you take a plain term insurance without any riders. Don't take it for 100 years. The agent may tell you take it for 99 years, 100 years. Why do you need that? Just take it till 65, 70 years. Basically, we as doctors have generally a good income. Most of our loans, EMIs are finished by that time. Our children are big, start earning on their own. So take it till 65, 70 years only. And there are some of these policies which they say that you have to pay more amount for initial 10 years, then less amount or no amount after that. Don't take those. Just keep regular annual premium till the policy period. No limited pay, no single pay policy. And make sure that you fill the form yourself. Don't just sign and leave everything to the agent, because any single mistake in the details may have a problem in claiming. Okay? And make sure you disclose any medical history. Best is that if they ask for a medical test, get it done. Get your medical test done. If something comes out, no problem. Maybe they may charge more, but later on, when you ultimately require that money, it will come easier. Okay? If you have a terminal illness waiver, disability waiver also topped on, no harm, take it. Okay? Like I said, have a medical test during buying these term plans. There'll be discounted term policies where they will say, okay, you don't require. But don't go into that, because they try to entice you in buying their policy, but when the time comes to claim, they will have the riders and they will delay the money. Okay? And if you have already some pre-existing life insurance policies, make sure you mention that in the form. Don't hide it, because these policies have a hidden clause that if there are any other policies taken, that have to be mentioned. Okay? And if any renewal is there, keep a reminder, maybe have an auto pay debit, so that you don't miss your, even single missing of the premium may cause a problem in the claim later on. And there's a thing called MWPA. I'll just come here. It's called Married Women Protection Act. Make sure when you're taking a new term policy, you should take that. Everyone should take that, because if you have a MWPA and there's some problem, you have demise, all the insurance money goes to your wife directly. While if you do not have a MWPA and you have a home loan, any other loans going on, the bank can interfere and take that amount from that. So have that MWPA. You cannot take it in between. You have to take it at the beginning of the policy. So if you don't have any term policy, make sure you take the MWPA. Okay? And make sure you have a document where you have all these informations already ready in the laptop. Your better half should have a knowledge about all these things. Okay? So I've already discussed about that. Regarding the health insurance, if you're taking an individual policy, take a minimum basic sum insured should be 25 lakhs. And if you're taking a family floater, your basic minimum sum insured should be at least 50 lakhs to 1 crore. In these days, the kind of health budgets which are increasing, minimum this much is required. Don't have any co-payment clause. Don't take any health insurance which says 10%, 20% co-payment. Avoid all that. Make sure that there should be no capping on the room and the ICU charges. There should be no capping on treatment even if you move to Tier 1 city. All the consumables must be covered in your health insurance. All modern or advanced treatments must be covered up to the sum insured, including all robotic surgeries. Now all these things are mentioned. Make sure if you're taking a health insurance, read the policy document before you sign on it. All these things are very, very clearly mentioned. Okay? And your no-claim bonus must generally increase 50% to 100% every renewal, for minimum 2 to 4 renewals. Okay? So make sure you have all these sub-clauses there in that. And lifelong renewal must be there. There should not be sublimit clause on any type of treatment. It should be auto restores. These are specific terms. Make sure if you're buying it from an agent, make sure all these terms are included in that. Okay? Otherwise there will be a problem later on. So I've already told about that. Maybe you can have the maternity benefit if you are young, dental benefits, restoration benefits, no claim bonus, free health checkups. Annually, they give some amount for free health checkups, which you are not aware. You can use that amount to get your health checkups, or for blood tests also you can use that. International treatments also should be available within a limit. Okay. Regarding the accident policies, generally these accident policies have where the vehicle is insured but the driver is not. Okay. So you can take an additional accident rider in that. Okay. And this will basically take care of your daily allowance for any loss of earning, your disability, your premium waivers, legal expenses, ambulance allowance. So all these things are covered. So there's no harm taking additional accident policy along with your health insurance. Regarding indemnity, we all know that all hospitals now require a basic indemnity for basically legal purpose. Besides this indemnity, if you have your own hospital, make sure you have a, yes.
What should be the minimum limit of indemnity?
So minimum for ophthalmologists, like for me in a Tier 1 city, 1 crore is the requirement. I think this should 1 crore as a surgeon. If you're a surgeon, 50 lakhs to 1 crore is the minimum amount we should have.
Sir, one query, whether it should be different for the hospital and for the individual?
So what?
Insurance policy, solo practitioner, and I'm having my hospital. Somebody else told me you do both the policy, one by the name of hospital, and other your personal policy.
Yeah, somebody is working in your hospital,
Yeah.
then you are also vicariously liable for their mistakes. Then when it comes, suppose there is some oxygen cylinder was not working, then his professional insurance may not cover. So the hospital insurance may have to cover it. So for that, it's better to have one for your hospital also.
Okay.
We have some international clients, right?
So Mike, please.
Hello.
Yeah.
We do have some international clients.
Yeah.
And I operated a young lady from Canada, and after reaching Canada, she started complaining about something.
Okay.
Later on, I came to know that the act did in India has to be claimed in India, so that's not an issue.
Yeah.
But in those cases, I think 1 crore is nothing.
That's right. So, but there's no end to it then. And generally, I think we should be just doing a good work. And ultimately, there's even a ROP case. I remember they had a
6
very-
crore.
No, it all depends on what kind of cases you are doing and what kind of clients that you are doing and the risk that is involved. That has to be
Because-
quantified by the
Because
surgeon.
unfortunately, I mean, even if you raise your claim, limits of insurance, they are not retrospectively
No,
applicable.
no, correct. Nothing is retrospective. So that's very important that you have your
So time and
indemnity
again, I think we
continuous.
need-
If it breaks,
Yeah,
also
yeah.
As
there
per
has to
increase.
inflation, we need to revise the
Yes, yes.
amount we.
And it's an annual, so these are annually you have to take. And basically, I think our All India Ophthalmic Society have also made a tie-up with Cover for You. So they say they will provide the legal cover, all these things. So make sure whatever indemnity you're taking have a legal cover also
Our
included.
Gujarat branch of IMA covers us for a crore in just 1,000 rupees.
So I think
I think having the IMA one is good. So you have, along with whatever you are buying, having the IMA one will be important. Your state branch, most of them have this additional thing. Even life insurance also, term insurance also, FBS scheme, the AIOS FBS scheme, and your IMA scheme will also be helpful because most likely these people will give the money to our family when we are not there. But insurance may not give. We expect our professional bodies to give. So having these two would be helpful, IMA and your like FBS here.
And Jani, I'll suggest whatever indemnity you take, make sure you have a legal cover in that. Because you may get a discounted one, but without any legal cover. When any problem covers, most of your time, stress, everything will go into that. So maybe pay slightly more premium, but have a legal cover included in that. Okay. So like I said, minimum 1 crore for high risk branches, 5 to 10 crore, like ortho, generally for us, not required. And make sure you have this 1:1 ratio. Basically, the amount of claim which comes, the company should be paying 1:1 and should not be less. These are clearly mentioned. We generally ignore. We don't know about it sometimes, and we should make sure that this 1:1 ratio is mentioned there. Okay. And like Raju very rightly said, IMA has very nice schemes. Legal teams easily approachable. They are less premium compared to companies. Only thing I think we have to become a member of the IMA
Yes.
for taking that. Okay, so again here, fill the form yourself, fill all the diseases yourself, whatever insurance you are filling, okay? And avoid the ignorance policies which are investment based, avoid ULIPs. ULIPs earlier used to be good, but last few years, the advantages have gone down, so avoid taking any ULIPs, okay? So I think this is the main about insurance. So just to make you aware, now I'll ask Raju to take over the.
I think the
Fair.
next team is ready, I think. I don't know.
debate. Maybe-
One question. Your take on PMS services?
So
PMS services.
sub PMS, like somebody mentioned here, when the market is going up, you feel good. But when the market is going down, they will continue to take your money. And ultimately, you see all these, even the economic papers, they have come out, compared the ultimate returns of this PMS service in the last 2-3 years. And 95% of them have given less return even than if you have invested you would have invested in a basic exchange traded fund.
Actually, I happened to read a coffee can portfolio by Saurabh Mukherjee.
That's the best example.
And recently,
Best example, sir, best example. So not only that, he's a social media person. That's why he's come into limelight. But I'm saying 90% of these PMS schemes have done worse than that.
but unfortunately, we don't have the expertise and time to buy share on time. That is the biggest issue.
So I think that's where this faith in yourself is there. If you 10-15 minutes you take out every day, we have actually a talk on how to select a good stock. I have a talk on how to select a good mutual fund on your own in 5 minutes, how to calculate that on your own. So if they are not waiting, maybe he can talk on that
Please,
stock.
please,
Yeah.
please, please.
I think
Today, last day, half day session, don't worry.
Yeah, so maybe I can
Until unless someone asks us to leave, please.
The other thing is, as far as health insurance is concerned, there's something called as a top-up policy. Okay, that works out cheaper if you compare. Like, suppose you want to buy a 50 lakh insurance. So the premium is quite high for that. So there's something called as a top-up or super top-up policy. After 10 lakhs to 50 lakhs, they'll cover. So first 10 lakhs will not be covered. So first 10 lakhs, you buy an insurance that is covering you for 10 lakhs or 15 lakhs or 20 lakhs. Anything above 20 lakhs to 1 crore, you buy a super top-up policy. So for me, the super top-up policy is around 6,000 rupees for a cover up till 50 lakhs, above 10 lakhs. So if you buy a insurance policy for 50 lakhs, your premium will go up to 1.25, 1.5 lakhs depending on your age at when you are entering. So super top-up policy will be helpful. So first 10 lakhs, your first insurance will pay. So they'll not come into the super top-up policy will not come into picture at all. Anything that is above 10 lakhs, they will pay you. So 10 to 50 lakhs, if you had a thing, that will be helpful.
one talk more. He said 945. Yeah. So that's what I was asking.
945.
You can take.
Okay. Right. That's one thing. And as far as insurance, don't go for money back policies. So that is the most commonly sold policy by LIC agents. As soon as you ask them, whenever you want to buy an insurance, don't mix insurance and investment. You tell them very clearly, you tell me only about pure insurance policies. Immediately, majority of them will run away or not come back to you. That is there because their margin of the commission is very less in term insurances. So that's why they want to give you. So almost it's around 12 to 15% of what you pay as premium goes to them as commission. So they always will try to push you for the higher ones. So always ask specifically, I want to know about term insurance only.
Raju, I think you can present your. Unfortunately, this instruction course was included at the last minute, just a week back. So they give us the first session on the last day. I think the organizers should include these kind of talks in the medium part of the sessions. These are the most important thing rather than the other talks. But that's okay. You pass on your knowledge to others and you'll gain.
So again, whatever we are discussing is how to select stocks based on some criteria, and this is a part of the WealthCon. And pranams to sir, Dr. Ramnath. He has actually converted many of the ignorant doctors into income generating doctors as far as the finance is concerned. So you need to go through this course, especially those who are not got involved with the other aspects of money management. So it's more important that we learn about the money management. So first thing is to set up your own Demat account. Before you do anything else, first go and do your own Demat account. Most of the times now it is online KYC. You don't have to fill forms. You just have to do, and online verification is happening in most of these brokers. So understand the terms of the user interface, how to place an order, how to buy a stock. Take guidance from a friend who has done it before, because this is overwhelming. When I started just after the COVID time. I also got into the market. Previously, somebody else was managing. Then we had a loss. Then we couldn't contact him for the losses when the losses happened. So choices of stocks are there according to what they would have bought. So when you are investing through PMS, there are a lot of things that happens. There is something called as a front running. So they are the fund managers. Even big fund managers are involved. You must have heard about some of the mutual funds managers who were caught front running. Front running is you have a stock, they will buy the stock first. Then when you are investing money into the mutual fund, they will start buying the stock. So they would have bought at 10 rupees, and then they'll use your money to increase the price to 20 rupees. And when it comes to 20 rupees, they'll sell off their investment, and you are stuck there. So somebody who entered the mutual fund would also have bought that stock at 20 rupees. So he is stuck with the loss. After that, the market goes down, he is stuck with the loss. So front running happens in majority of them. But as retail investors, we cannot predict when it is happening, how it is happening, but we need to be aware of these terminologies at least. How to select a good using what is called as an MPTDS criteria. This is what, to make it simpler, see basically why Ramnath sir has done all these things, says Ram sir, is to simplify the things so that doctors themselves start doing it for take care of their financial journey. So most of the times retail investors fall prey to tips trading, follow blindly some financial guru without understanding. So as I said, to initiate and encourage ourselves to start learning about doing stock selection of our own and how to do fundamental analysis. There are two things whenever you are buying a stock. One is called as a fundamental analysis, other is called as a technical analysis. So what we are talking now is the fundamental analysis, not the technical analysis. Technical analysis, you are trying to time the market, seeing what is called as a support zone, what is called as a resistance zone, and you buy when it is at the lower level, that is a support zone, and you want to make a profit, you have to sell it near the resistance. So those things all will be taught in the trade vesting courses that will be done. But to begin with, so if you want to have a long-term portfolio, this is MPTDS, whatever we are saying is for large caps. So you again, your criteria you have is you have stocks which are called as banking and non-banking now. Again, in non-banking stocks, you can have dividend paying and dividend non-paying. So these are the various types of stocks that you have. For the dividend paying stocks, you use what is called as a MPTDS criteria. For the dividend non-paying stocks, you use what is called as a MD Sport criteria. So MD Sport, each one M, everything stands for a particular term. For banking, we use what is called as a MG Sport. Okay, these are the terminologies that are used. So why it is required, as we told you, we are looking at selection of fundamentally strong companies. It's a passive investment. You can also do active investment or trading because these are safer companies to trade. Then you can do SIP buying or DIP buying, as Dr. Nikhil was telling. And minimum duration is to have and hold these stocks for longer duration, not for shorter duration. This is again important if you want to create long-term wealth. So this is the criteria that have been put up. One is the market capitalization. So market capitalization is how much is the total number of stocks of that company into the current price of the company, stock price of that company. So that will give you the market capitalization. So choose companies which have a market capitalization above 10,000 crores. Then the price of that stock from its start, when it started till now, it should be in an uptrending phase. It should be going up and up. Its tax that it is paying to the government should also be increasing year on year. That means to say that this company is making profits, hence it is able to pay tax to the government. So the tax also that the company is paying should be increasing over the last 10 years at least. Dividend that the company is paying should be increasing, and the sales should be increasing. See, so he has put minimum things here. There are a lot of things which are there, but these are the minimum things that they have put up. How to assess? You can use the website called as screener.in, and you can type in these criteria. So as we told you, so if you chart this graph for the last 10 years of TCS, you can see that the price has been increasing. Although you see that it has gone up, down, gone up and down, gone up and down. But if you join from 2014 to 2024, the chart has actually gone up over a period of time. Although it has come down, come up, come down, come up. So this is how you should want the chart to be over a period of time. If you see this another stock, which is called as ONGC, you can see that it has not gone anywhere for the last 10 years. It started at 300 or 250, and it is remaining at the same price over a period of time. So this is the thing that you don't want to choose. So it's not uptrending as far as the price is concerned. Although the market capitalization is more than 10,000 crores, but the stock price has not increased. Limitations, most of these companies are mature or at a steady level of growth. You may have relatively lesser income or returns in this, but you will have safer returns. So low risk, low returns. But you can add diversification, you can add some higher growth companies also to this, okay? So for that you can choose what is called as the MD Sport. So here we are talking about companies again with more than 10,000 crores. Your debt to equity should be less. So make sure that you understand these terms, debt to equity. So how much the company has taken loan to run this business versus how much is it worth in the market. So if it should be less than 0.3, that means they should have taken, if their equity is worth 1 rupee, they should have taken more than 30 paisa of debt. That is what it means. Then we need to look at the operating margin. Then there is something called as an ROCE, that is return on capital employed. How much capital they have used and how much they have got back. So select which has got more than 20% is the best. Again, you may have to reduce or increase these numbers depending on what stocks that come out of the screening. Then the sales growth, then profit after tax, and tax that is paid. So these are the things that will be taken care in the MD Sport criteria. As far as the growth of the this is the criteria that we use, more than 15%, and return on capital employed more than 20%. So using this, then we screen the companies. So there are various parameters, I think operating profit margin, there are many terms. So once you get into the financial learning journey, so you will all be learning these terminologies one by one. Otherwise, it is very overwhelming. It takes a lot of time to understand these terminologies. So we have given a score. This has to be done on a Excel sheet. And once you have a total score that is more than 75, these are called as valid stocks. If it is less than 50, these are called as invalid stocks. So you have to score them based on this, and you will have a watch list of forward. If it is between 50 to 75, then you put them in the watch list, and then see if they're performing well, and then you can enter the criteria. So the main aim is to standardize the selection criteria using a scoring system to eliminate the risk of averaging due to inconsistent and volatile numbers. Sometimes, like when you have a COVID, or now you had a market crash or a Trump effect, now suddenly because of this volatility, their sales may suddenly dip now. So to take into consideration, you have to take for a longer period of time and then average it out and then score them. So if you score them based on this, so you'll be able to select good quality stocks. Banking related are used a different criteria. This is called as a NG Sport, wherein there is something called as a gross non-performing asset. So this is to be used. So many banks, as you know, would have given loans, and after taking the loans, the person who took the loans vanishes off to another country. So that loan becomes a non-performing asset. So they should have the least amount of non-performing asset. So this is the screener website that is there. So you have to use the screener website and put the whatever criteria that we told you. So this is a video that will show you how to do this. So when we put a criteria, say here, the first criteria we put was market capitalization more than 10,000 crores. So when you did this, you see that approximately, sorry. So you saw around 451 companies came up when you just put only one criteria. Okay. So then you change it to the criteria that is required. Now we have put all the criteria now. So how to do it? You have to do it market capitalization more than 10,000, then and has to be used. Then you have to put all these things, whatever is required. Then you should run this query. So you can use this. It is free. This is all free on the website there. And then once you run this query here, then you got just 18 stocks now. Just 18 stocks. Now again go back and see all of them, and then see for each of them you have to select and do the calculations for all of them, profit, loss, and whatever is there, and then put them into Excel and do the charting. Okay. So you have to do this based on whatever is there. You have to download all. So some work is required to do these things, but if you learn to do it yourself, then you will be able to select the stocks for yourself. So then the charts are there that will show you how the performance has been. So you can compare various charts of various companies and then make a list of about 5 to 10 companies that you want to invest in over a period of time. Okay. So for passive investors, as we told you, you can just invest in these what are called as Bs, Nifty Bs, Junior Bs, Mid 150, Gold Bs, Bank Bs, Junior Bs. So if you don't want to do all these things, so you can just think of buying these through the Demat account. So again, we are told about dip buying. So whenever the market is coming down, have some money in your bank to invest it so that it will give you a better return over a period of time, and have it and hold it for long term. Okay. So as we told, you need to diversify your portfolio. Then only the overall CAGR will increase. Good selection of 20 to 30 stocks can be done. So it's important that we become self-reliant to achieve the financial freedom. Thank you.
Thank you, Raju, for for this nice talk. And ultimately, the aim of this instruction course is to just make you aware that we as doctors should not be befooled by these agents. We should take this thing, finance, into our own hand. Ultimate aim is to become financially independent and to become Atmanirbhar. And if we can do it, you can do it. Okay? So start it from today, and thank you for taking out time on a Sunday morning, last day of the conference, and we really appreciate your presence. Thank you. Thank you.
Thank you, audience. Thank you for being here.
Maybe you can come on the dais for a photo with us, please. Just one.